After you take advantage of all other forms of financial aid, including federal financial aid, federal student loans, and outside scholarships, you may still have expenses you need to cover to pay for your education. That's when you might want to consider private student loans. Private student loans can help you fill the gap between what federal, state, scholarship, and school assistance provides and what you actually need in order to afford higher education. Much like auto or home loans, private student loans are based on credit. Most students will need a credit-worthy cosigner, such as a parent or other relative, in order to obtain this loan type. Good credit is the key to being approved for a private student loan and obtaining favorable rate. Terms and conditions applicable to these loans vary greatly, and it's important to pay careful attention to the terms you are offered before making a financing decision. Private student loans are offered by banks and other lenders. The loan programs offered by these lenders have specific terms and conditions as well as rates and vary from program to program. Again, credit will play a role in determining the rates a borrower may be offered. Factors to consider when researching and choosing a private student loan include interest rate, total cost of loan, annual percentage rate or APR, length of repayment, loan minimum and maximum, loan fees, borrower rewards, repayment incentives. A private student loan is made in the name of the student borrower and is backed by a cosigner, in most cases the parent. In a sense, because the student is the primary borrower, they have skin in the game, and many parents feel bearing this responsibility will teach their child the valuable life lessons that can only be learned through experience. Students can usually borrow up to 100% of their cost of attendance, minus financial aid including other student loans. Typically, there is a minimum amount for private loans, usually around $1,000 to $2,000. Rates can vary greatly per lender and borrower. Shop around and find the best option for you. Some private lenders now offer fixed rate loans as an option. Fixed rates tend to be higher than the current variable rates as the lender is hedging against rates increasing substantially while the borrower is in repayment. If you are wary of your interest rate rising substantially during a repayment term, a fixed rate can offer peace of mind. Many times, an origination fee will not be charged. When a lender does charge a fee, that fee is added to the loan amount you request. However, fees can also come into play if you miss or make a late payment. One feature of many private loans is the ability to completely postpone or defer payment of principal and interest until you graduate from college. However, many lenders require a small token payment while you're in deferment. These payments are usually in the range of $25 to $50 a month. Making these payments will help reduce your cost of borrowing and also establish the habit of paying your loan on time every month. It's a great way to really understand the responsibilities that come with borrowing. Finally, some loan programs require interest-only payments while you're in school. You only begin repaying principal and interest after you are no longer enrolled. Whether you fully defer, make a token payment, or pay interest only while you're in school, making proactive payments against your loan is always a good idea. While we actively encourage students and families to pursue federal student loan options before considering private education loans, there are many situations where a private loan may be a good alternative. Remember, borrow only what you need and carefully compare private student loans before you borrow. We've created Loan Finder, a loan finding tool to help match students and parents to eligible loans while uncovering all data before you begin the application process. Looking for more financial aid information? Don't miss any of our other financial aid videos. And follow along with us on social media.